Hey, we're back to discuss some more options flow. This week provided a lot of great opportunities to utilize some of the analysis that we've shared on the YouTube channel. Let's talk about a crazy earnings trade for ticker Docu. On Thursday, with Docu trading at $88, we spotted two bear put spreads being traded at 3:34 p.m. and 3:35 p.m. A 75.85 strike bear spread and a 73.83 strike bear spread as well, both expiring the very next day. The market did not react kindly to the earnings call, sending shares of Docu plummeting. The put spreads ended the day deep in the money for maximum gain. Now let's talk about this spread. I'll be using this post from the Unusual Whales blog to assist in the breakdown. You can see each of the two spreads here. For those unfamiliar, a spread is an option strategy in which a trader will buy and sell multiple options of the same type for the same underlying asset. There are many types of spreads. In this case, we're looking at two bear put spreads, more properly known as a vertical put debit spread. Side note, if you're new to spreads, I would definitely check out the Unusual Whales options profit calculator. You can read about and visualize how different types of spreads can profit. Let's just take a look at the 75.85 vertical put debit spread. Here, I've plugged the trade into the Unusual Whales options profit calculator. We are buying the 85 put at 510 and then selling the 75 put for 177. This gives us a final trade cost, or debit, of $333. We are still bearish Docu, but using a spread in order to limit our risk, at the cost of reducing our max gain. The simple calculation for the max gain of a vertical debit spread is the width of the strikes, 10 in our case, given the difference between 75 and 85, subtracted by the cost to enter the trade. $1,000 subtracted by 333 leaves us with a max profit of $667. Docu closed on Friday at about $66. The traders who opened the spreads left a lot of money on the table, having opted for the spreads rather than the lone put positions. Remember, we just broke down that the max profit for these spreads was about $667. A lone 85 strike put would have profited about $1,400 instead. Hindsight is, of course, 2020. Consider an alternative scenario in which Docu does not crater to 66, but instead closes at 77. In this instance, it would be to your benefit to open a spread rather than the lone put position. The lone 85 strike put, which was trading for 510, would be worth $8 for a gain of approximately $290, or about 56%. However, the 75.85 strike put spread, which is opened for $333, would still be valued at $8, but from the entry price of $333. This would result in a gain of about $467, or approximately 140%. I hope this look at spreads was insightful. If you haven't already, make sure to check out our other videos for some more options flow tips.